Welcome to Voice Daily Finance, the most important news personalized for you every day. Supported by Voice.com.
After listening to today's news, you'll know first US economy unexpectedly sheds 92,000 jobs, shattering the stabilization narrative and putting the Fed in a difficult policy bind. So we'll discuss why this sharp downturn complicates the Fed's inflation fight and what it means for the odds of a June rate cut. Second, Canada's PM declares the USMCA trade deal effectively broken as Japan warns its auto investment hinges on the high-stakes negotiations. We'll explore how this trade conflict creates massive uncertainty for global supply chains and could reshape North American business investment. Third, jet fuel prices explode over 80% as Gulf disruptions threaten a physical shortage, pushing up CPI inflation and summer airfares. We'll analyse why this price shock matters now for the Fed's inflation fight and how it could lead to widespread flight cancellations. Let's start with a single statistic that might just change your entire perspective on the economy. Wall Street was expecting 59,000 new jobs. Instead, the US economy just lost 92,000. A while back, we noted that the prior 2 months were revised down by a combined 69,000. So this isn't just a one-off wobble, it's an extension of a cooling trend. That's not a typo. The latest employment report shows an unexpected and widespread decline in non-farm payrolls, sending the unemployment rate up to 4.4%. Now, the tricky part with these monthly numbers is their volatility. You see, the government actually uses two different surveys to measure the job market, and sometimes they tell conflicting stories. One survey asks businesses, while the other asks households. When you add in temporary disruptions like the strikes and storms mentioned in this report, it makes the true state of the labour market very difficult to read from just 1 month's data. This data unreliability raises the risk of a policy error, as the Fed might be forced to act on noisy signals. This is the second largest job loss since January of last year, and it's throwing the Federal Reserve's entire narrative of a stabilising labour market into doubt. Continuing our last discussion about a potential shift in the Fed's reaction function, this report directly tests that stance and the Fed's dual mandate. While factors like worker strikes and winter storms played a role, the weakness was nearly across the board. The healthcare sector shed 28,000 positions, construction dropped by 11,000, and leisure and hospitality lost 27,000. Even the federal government shed another 10,000 jobs. To really grasp the breadth of this, economists look at something called the diffusion index. Think of it as a measure of how many industries are actually adding jobs. That number just fell to 50.8%. A reading of 50% means job gains and losses are perfectly balanced. So we are right on the edge. It's a key metric because this index is less volatile than the headline number, and a sustained drop below 50 often signals a genuine economic downturn. The trend is stark. Average job growth has plummeted from 50,000 per month down to just 6,000 per month in the last 3-month period. This all puts the Fed in what the report calls a difficult spot. How can it justify its patient stance on rate cuts when the labour market is flashing red? This is happening while the economy is also facing rising oil prices and renewed tariff discussions. A few days ago, we mentioned Cleveland Fed President Beth M. Hammack warning that if inflation doesn't make clear progress toward 2%, policy could even get more restrictive. Today's labour slump pulls hard in the opposite direction. So the thing is, this combination of a weakening job market and rising cost pressures is a classic recipe for stagflation. That's stagnant growth plus high inflation. And that's the Fed's worst nightmare. It's a trap because the tools used to fight inflation, like raising interest rates, would hurt the weak job market even more. But cutting rates to help jobs could make inflation worse. And on the topic of tariffs, the data suggests that these policies are creating a significant drag on the industrial sector. Despite political promises, manufacturing employment continues to decline, which could signal a deepening industrial slowdown with negative effects for complex global supply chains, including those between the US and China. As we discussed before, Fed research shows that almost all of the tariff costs get passed through to US. Importers and consumers pair that with higher oil, and you amplify the inflation impulse even as output softens. One top economist at Fitch Ratings put it bluntly, saying, "It's bad news whichever way you look at it." He added that with these new pressures, the Fed is basically a deer in the headlights until these numbers settle into a sustainable, actionable trend. The market is already reacting, with the odds of a June rate cut now increasing. This report has shattered the stabilisation narrative. The new reality is a labour market operating with a much thinner supply buffer, raising the risk that even as demand cools, wage pressures could remain stubbornly high. This brings us to the core puzzle. Why are wages sticky even as jobs are being lost? The answer seems to lie in the overall labour supply itself. Recent research suggests the US labour force is structurally smaller than previously thought, partly due to weaker net immigration. When there are simply fewer available workers, businesses have to compete for them, which keeps wages high even if total employment is falling. This implies a higher natural rate of unemployment and persistent wage-driven inflation, putting the central bank in an incredibly difficult position. Speaking of tariffs creating a drag on the industrial sector, the tension is ratcheting up on the US northern border as well. The free trade agreement between the United States and Canada has been, quote, effectively broken. That's the explosive statement from Canadian Prime Minister Mark Carney as high-stakes trade talks resume in Washington after months of silence. At the center of the storm is the US-Canada-Mexico Agreement, or USMCA. The Trump administration has openly considered scrapping the entire deal, a move that would upend decades of North American trade. A crucial detail that's creating a lot of this uncertainty is the mandatory USMCA review scheduled for 2026. This review clause could trigger annual reviews if there's no consensus, deterring long-term business investment in Canada. The conflict has already inflicted real damage. The US has imposed a new worldwide 10% duty under a never-used law, on top of painful, sector-specific tariffs on Canadian steel, aluminum, and automobiles that have already led to thousands of job losses. This isn't just about specific industries. A new, broad tariff authority represents a systemic threat that goes far beyond just one or two industries. The core issue is the massive global trade policy uncertainty it creates. This forces companies that rely on predictable supply chains to reprice their risk, which can slow down investment and complicate inflation forecasts for central banks. But this is where the situation takes a more complex turn, and it involves another global superpower. A staggering 70% of all cars manufactured in Canada are made by Japanese companies. And Japan has just issued a stark warning. Its continued support for Canada's auto sector hinges entirely on the successful outcome of these USMCA talks. The deeply linked supply chain means a single vehicle crosses North American borders multiple times before it's sold, and US officials have previously stated they want that manufacturing shifted completely to the US. Interestingly enough, the USMCA agreement itself was built to encourage this very shift. It contains very strict rules of origin, raising the requirement for how much of a car must come from North America from 62.5% to 75%. It also added a new rule that 40 to 45% of a vehicle's value must be made by workers earning at least $16 per hour. This is the mechanism intended to pull jobs into the US, and also why there's a risk of a zombie USMCA, an agreement that exists on paper but is effectively killed by new tariffs, which could mean higher car prices for American consumers. This all begs the question, what's Canada's endgame? The answer is a dramatic pivot away from its southern neighbour. While talks are happening in Washington, Prime Minister Carney has been in the Indo-Pacific, signing deals worth billions with India, including a 10-year nuclear energy pact and fast-tracking a new free trade deal. It's a bold pivot, but when we place Canada's current state alongside its goal, the scale of the challenge becomes clear. Research shows that current growth in non-US exports is nowhere near enough to offset a major disruption with the US. After all, while the US market accounts for nearly 70% of Canadian exports, major Asian markets like China and India only account for about 4% and less than 1%, respectively. This isn't just a negotiation, it's a fundamental realignment. Elected on a platform to reduce economic reliance on the US, the Canadian government no longer views its largest trading partner as reliable. So, what's next? The key focal points to watch are, first, any new developments surrounding that 2026 USMCA review. Second, keep an eye on foreign investment data for the Canadian auto sector, as a sharp drop could signal a long-term shift. Finally, watch the real export numbers from Canada's new trade deals to see if its diversification strategy can truly gain traction. That fundamental realignment of trade is a huge story, but it's not the only global supply chain under extreme stress right now. Let's shift our focus to the energy markets, where a critical choke point is causing chaos for travellers. Now get this, The cost of jet fuel has just exploded by more than 80%. Following supply disruptions in the Gulf, the price of aviation kerosene has spiked from $830 a tonne to over $1,500, the highest level since 2022. The Gulf region is a critical supplier, and most of its fuel flows through the now effectively closed Strait of Hormuz. Today's jump is that geopolitical risk finally punching straight into aviation fuel. The Strait of Hormuz isn't just another shipping lane, it's the world's most important oil choke point. The situation presents a fascinating duality. What we're seeing now isn't an accidental blockage, but a targeted conflict, weaponizing these critical trade choke points, forcing a repricing of risk across many assets, far beyond just oil. The financial fallout is already happening. Wizz Air has warned the conflict will slash its annual profit by 50 million euros. And it's not just a European problem. The head of United Airlines has already signaled that ticket prices could rise soon, suggesting the impact will probably start quick. And this isn't just about your summer vacation budget. Believe it or not, the price of airline tickets is a key component of the Consumer Price Index, or CPI. A jump in airfares can signal broader inflationary pressures in the services sector, making it much harder for central banks like the Federal Reserve to justify cutting interest rates. This is a crucial part of the last mile of the fight against inflation. Now, you might think major airlines are safe because they hedge their fuel costs, but that's not the whole picture. What really brought this to a head is the difference between a price shock and a physical shortage. Financial hedges don't create fuel, and we are now seeing clear signs of a physical supply crunch. For example, jet fuel inventories in the critical Amsterdam-Rotterdam-Antwerp hub have fallen to their lowest level since early 2025. Hedging protects against price, not a physical lack of fuel. This crisis also reveals a stark difference in business strategy. Heavily hedged European carriers like Ryanair are somewhat cushioned. In contrast, many US carriers are less hedged, making them far more exposed to these immediate price spikes and potential shortages. And even if OPEC Plus increases output, more crude doesn't immediately solve a refined product bottleneck when the key strait is effectively closed. According to one market intelligence expert, even airlines with long-term contracts could see their suppliers cut production. This means airlines could soon be scrambling to find fuel from alternative sources, a challenge made worse by surging prices everywhere. So what's causing prices to surge everywhere? It's kicked off a global bidding war. Europe's scramble for non-Gulf fuel is diverting cargoes that were originally meant for Asia and the Americas, benefiting US refiners, but putting immense pressure on Asian airlines. This all leads to a stark warning from inside the commodities market. An expert from Sparta Commodities was asked if this could lead to flight cancellations. His answer, I think we're weeks away from maybe flight cancellations or delays due to lack of jet fuel rather than months. When asked if this means higher prices for passengers over the summer, his response was even more emphatic, very much so. So, what are the immediate takeaways? First, watch for an increase in flight delays or cancellations, especially in Europe, as a sign of the physical shortage biting. Second, expect airfare inflation to remain a stubborn problem. The key indicators to watch going forward will be the weekly jet fuel price updates from the International Air Transport Association and, critically, the weekly inventory reports from storage hubs like ARA. These will be the leading indicators of whether this crisis is deepening or starting to ease. All market information is subject to rapid change. This is not investment advice.
That's it for today on Voice Daily Finance. Follow, share, and stay tuned for daily updates coming your way tomorrow.